Have you ever just stopped to think about how quickly retail is changing? I mean, really changing around us.
Oh, absolutely. It feels like 1 minute it's all about, the physical store experience.
Right, and the next, boom, digital disruption everywhere.
Exactly. And then you have these like subtle shifts in what people actually want, creating whole new markets.
It's definitely a whirlwind, a real whirlwind.
Keeps you on your toes, that's for sure. Consumer tastes, tech, even demographics, everything's moving so fast.
It really is. And that's why today we're doing a deep dive into a company right in the middle of all this dynamism. Trent.
A major player in Indian retail, yeah.
Definitely. We've spent time going through a recent company update from Motilal Oswal, trying to pull out the really crucial bits.
To give you that comprehensive picture without getting totally swamped in data.
Exactly.
Yeah.
Our mission here is to get past the headlines, to really understand Trent's growth plans, their strategies.
And the market forces they're dealing with, what's actually driving things.
Right. So let's maybe kick things off with the big picture. The sheer scale of the retail opportunity in India. It's just staggering, isn't it?
It really is.
What makes India such a compelling story for retail right now?
Well, the numbers alone are pretty mind-blowing. We're talking about an industry around USD 1 trillion right now in 2025.
Okay, $1 trillion.
Yeah. And projected to more than double, get this, to USD 2.2 trillion by 2034.
Wow. That's massive growth in less than 10 years.
It's huge. And it's not just, overall retail.
No, the fashion and lifestyle part seems particularly hot, right?
Precisely. That specific segment is looking at a CAGR, a compound annual growth rate of maybe 10 to 12%.
Okay.
Which means it could hit something like INR 18 trillion by 2028.
So what's fueling that specifically?
It's a mix of things, really. You've got India's massive young population who are increasingly aspirational.
Wanting the latest styles, the brands.
Exactly. Then there's rapid urbanization, more people moving to cities, more consumer hubs.
Fix it.
And of course, the huge impact of digital. Everything's more accessible, even if the final purchase is still in a physical store sometimes.
Okay, so digital access, young aspirational consumers, urbanization. That paints a picture for fashion.
Yeah.
But what about something different, like, say, groceries? Is it the same story there?
Similar trends, but with a twist, maybe. In organized food and grocery, the big thing we're seeing is this move towards premiumization.
Premiumization, meaning?
Meaning people are more willing to pay a bit extra for convenience, for better quality, maybe products linked to wellness goals.
Right, so it's not just about the basics anymore. It's a more curated shopping trip.
Exactly. More thoughtful.
Okay, so we have this huge growing market shifting tastes. Now, Trent, they've seen amazing growth, right? Like 6.5 times revenue increase between FY19 and FY25.
Phenomenal growth, yeah.
But despite that, their overall market share in fashion and lifestyle is still, pretty small. Low single digits.
That's the fascinating part, their ambition versus their current position.
So how are they planning to bridge that gap? How do they get bigger faster?
Well, what's really interesting is their plan to hit that aggressive target they're aiming for, 25% plus annual growth long term.
Okay, that's ambitious.
Very. And they're not just banking on same-store sales growth or SSSG, getting more sales from existing stores.
Right. So what's the core strategy then?
It's what they call a multi-brand cluster-based approach.
Multi-brand cluster base. Break that down a bit.
Sure. Multi-brand is clear. They have Westside, Zudio, Star, others. Cluster-based means they're not just scattering stores randomly.
Okay.
They're deliberately concentrating different brands within specific small areas or micro markets. Like you might find a Westside and a Zudio, maybe even a Star, quite close together in one neighborhood or mall area.
Ah, I see. Kind of saturating a key area.
Exactly. It builds local awareness fast, targets specific customer segments in that area, and probably gives them some efficiencies in logistics or local marketing within that cluster. It's about winning market share in those specific zones.
That cluster idea makes a lot of sense for digging deep locally. But with different brands like Westside and Zudio, how do they keep customers loyal to each one, make them feel distinct?
That's crucial. It comes down to their differentiated proposition. They work hard to offer a really unique customer experience for each brand format.
So the front end, what the customer sees, feels different.
Right. But here's the clever part. The back end is highly integrated. Supply chain, warehousing, the tech systems, that's all unified.
Ah, so efficiency behind the scenes, variety out front.
Pretty much, that's the goal.
But expanding like that, especially opening stores in clusters, Doesn't that hit the financial returns, at least initially? Are they worried about that?
They're definitely aware of it. The management team knows this cluster approach could impact return metrics in the short term.
Okay.
But their belief is there's enough headroom to drive what's called operating leverage.
Operating leverage, meaning profits grow faster than sales eventually.
Exactly. As revenue scales up, those fixed back-end costs get spread over more sales, so profitability improves. They're banking on continuous process improvements to make that happen.
Got it. And when they pick spots for these new stores, what are they looking for?
They're very strategic. Key things are obviously the location itself, the type of building or scheme. Is it in a mall, high street? What's the catchment like?
Right.
And the store economics. Plus, having that density in micro markets actually helps them. It can give them more bargaining power on leases because landlords know trend drives footfall.
Okay, that makes sense. So seeing how each piece fits, that's really insightful. Let's maybe get into the specifics of the brands, starting with, say, Westside and Zudio, the fashion leaders.
Sure. So Westside, as of FY25, they had 248 stores, added a net of 16 that year.
Okay.
And their online channel is doing well, about 6% of Westside revenue. Interestingly, it's almost all full-price sales online.
No heavy discounting needed there, it seems.
Apparently not. And here's a telling stat. Club West members, their loyalty program, they account for a massive 90% of Westside's revenue.
90%. That's huge loyalty.
Incredible loyalty. Then you have Zudio.
Which has just exploded, right? What's the story there? That growth seems phenomenal.
Explosive is the right word. They hit 765 stores in FY25. That was 220 net new stores in just 1 year.
220, wow.
Yeah. And their strategy is just push, push, push. Entering new cities, but also adding more stores in cities where they already are, deepening the presence.
And Zudio is purely physical stores, right? No online?
That's right. Zero online strategy, which is fascinating in today's world, isn't it?
It really is.
Yeah.
Why do you think that works so well for them?
Well, for their specific model value-focused fast fashion, the physical store offers that immediate gratification. Impulse buys. Low friction.
Makes sense, especially in maybe tier 2, tier 3 cities.
Exactly. Where online shopping for fashion might still be developing, the physical store is king. It seems to be a massive differentiator for them.
Interesting. And they're looking abroad too.
Yeah, apparently the early response to Zudio's international tests has been good. And there's even talk Westside might go global eventually, too.
Interesting. So different channel strategies. What about pricing? Do they just hike prices every year?
Not usually on the same exact item. Their approach is generally to avoid direct price hikes like that.
So how do average selling prices, ASPs, go up then?
Through the mix. They'd change the product assortment, introduce slightly higher value items, maybe more premium fabrics or styles within the collections. That lifts the average transaction value without slapping a higher sticker on the same old t-shirt.
Clever. Okay, so fashion's flying. Let's switch over to Star, the grocery side. The picture seems a bit different there.
It is a bit different. Star saw decent revenue growth, around 25% in FY25. Added 12 net stores, which is about 18% growth year on year.
Okay, growth,
But the footprint is still small, only 78 stores across 10 cities, which seems tiny compared to the potential management sees in Indian grocery. They're still very bullish long term.
Right. Grocery is just such a different beast than fashion, isn't it?
Yeah.
What are the big challenges there, and how does their strategy try to tackle them, like that private label push?
You nailed it. Scaling grocery in India is tough. You've got complex supply chains, perishables, intense local competition everywhere, different tastes region to region.
Yeah, it sounds incredibly complex.
It is. So Star's big differentiator is pushing their own brands, the non-third-party stuff, their private labels. They're at 73% now, aiming for 85%.
And why is that so important?
Several reasons. Better control over quality, better control over pricing, potentially higher margins because you cut out the middleman.
And unique products you can't get elsewhere.
Exactly. Creates a reason for shoppers to choose Star. But despite that strategy, it's still tough going. Their gross margin dipped slightly in FY25, and they actually slipped back into operating losses.
So profitability is still a challenge there.
Definitely highlights how competitive that grocery space is.
This brings up a really interesting point. How do these very different strategies, like Zudio's massive, rapid expansion versus Star's more measured, maybe more challenging growth, how do they fit together in the bigger picture of grabbing market share?
It really shows they're playing different games simultaneously, doesn't it? Zudio is the volume driver, the market penetration engine, get the brand seen everywhere, grab share quickly with accessible fashion.
Right, scale and visibility.
Yeah. SAR, on the other hand, is a longer-term play in a huge but very complex market. It's about building differentiation through own brands, aiming for premiumization, even if profitability takes longer to achieve.
So one drives immediate scale, the other builds a different kind of value.
That's how it looks. They're diversifying their bets, really. Zudio gets the top line moving fast. Star tackles a different, potentially very rewarding but harder segment. It builds a more robust overall portfolio.
Makes sense. Not putting all their eggs in one basket.
Yeah.
And besides these main formats, they have these emerging categories too.
Yes, and they're becoming quite significant. About 20% of Trent's total revenue now.
20%, that's substantial.
It is, and the volume growth is pretty spectacular in some areas. Like beauty, mostly through Zudio. Beauty saw 65% year-on-year volume growth. That's 81 million units sold.
Wow, 65%.
Innerwear grew 47% year-on-year, 50 million units. Footwear up 42%, 27 million units.
That footwear number is huge, beating established players.
Yeah, the report mentioned it surpassed competitors like Metro and Campus in volume terms. Really impressive growth in those add-on categories.
So they're building ecosystems around their core fashion brands. And didn't they just launch something totally new as well?
They did. Lab-grown diamonds under a new brand called Pome.
Diamonds, okay, that's unexpected.
It certainly signals they're willing to explore, potentially high-margin areas that tap into changing consumer aspirations. Very interesting move.
Definitely one to watch. So bringing this all together, if we look at the financials, the projections seem pretty optimistic, despite the challenges like with Star.
Yeah, connecting it back, those financial forecasts really underscore the confidence analysts have in Trent's strategy and the market opportunity.
So what are the headline numbers looking like?
The projections show consolidated revenue growing from about INR 171 billion in FY25 up to INR 265 billion by FY27. That's a significant jump.
And profits.
Consolidated EBITDA, that key profitability measure, and adjusted profit after tax are both expected to grow at around 25-26% CAGR over that same FY25-27 period. Healthy growth on both top and bottom lines.
Okay, strong growth. But can they maintain profitability, their margins, with all this expansion?
That's always the question, isn't it? But the projections suggest EBITDA margins should stay pretty stable, around 16.2% for FY26 and FY27. So the expectation is that operating leverage we talked about will kick in, allowing them to grow aggressively while maintaining healthy margins.
So looking ahead, what are the really key things to keep an eye on, the main monitorables?
I'd say two main things stand out from the report. First, you want to see that same-store sales growth, SSSG, recover and strengthen across both fashion and Star.
Right, getting more from the existing stores.
Exactly. And second, the impact of Zudio's store openings. A lot of those 220 stores were added towards the end of FY25, so they call it back-ended.
Meaning they haven't hit full speed yet?
Precisely. So the expectation is those stores will mature and really start contributing significantly to growth in FY26. That's a key factor underpinning the positive outlook.
Okay. And the final verdict from the analysts at Motilal Oswal?
They've kept their BUY rating on Trent. The target price is unchanged at INR 6,900.
Which represents what kind of upside?
About 20% upside from the share price when the report came out, which was INR 5,735 back on June 18.
And the valuation, is it looking stretched?
Well, they value the standalone business at 77 times projected FY27 earnings per share. That sounds high, but Trent has historically traded at a high multiple. Its long-term average one-year forward PE is around 90 times. So 77 times future earnings might actually suggest decent value given the strong growth prospects.
Interesting perspective. So wrapping this up for our listeners, what are the big takeaways here? What stands out most from this deep dive into Trent?
For me, it's the combination of ambitious scale and strategic diversification. They're not just growing, they're growing smartly across different formats.
Yeah, we've seen that robust strategy, the diverse brands, all aimed at that huge Indian market opportunity. It's that multi-pronged approach, isn't it? Zudio's speed, Westside's loyalty, Star's potential, the emerging categories.
Exactly. It positions them really well.
And it leaves us with a thought, maybe. How might this unique cluster-based multi-brand strategy change how we think about retail success, especially in fast-growing economies like India?
That's a great closing question. Could it redefine the metrics? And what lessons are there for businesses, maybe in other emerging markets facing similar rapid urbanization and changing consumers? Lots to think about.